$1,000. That is the number most people cite when asked what they would need to start investing. And here is the thing, they are right. $1,000 is enough. The question is why most people who have it, or who are close to having it, still have not started. The answer is not what most financial content tells you. It is not a lack of information. It is not a lack of opportunity. And it is most definitely not a lack of money because, as we are going to establish very clearly in this video, you do not actually need $1,000 to start. That number is a psychological threshold more than a financial one. The real barrier to investing is almost never about the money. The real barriers are specific. They are named things. They are the feeling of not knowing enough yet to make the right decision. The concern that the market looks uncertain and the timing is not right. The sense that the amount available feels too small to make any real difference. The worry about choosing the wrong thing and losing the money. And the persistent belief, despite knowing better, that starting later, when conditions are more favorable, will somehow produce a better outcome than starting today with what is available right now. Every single one of these barriers is real. Every single one of them is understandable. And every single one of them is more expensive than the thing they are protecting you from. Because the compound growth foregone during the period of delay, every month that passes while the barriers feel too large to step past, is a permanent cost, not recoverable, not compensable by investing more later gone. This video is the guide that removes every barrier. We are going to go through 7 specific steps, in the exact order that they need to happen, for investing your first $1,000 correctly, confidently, and this week, not eventually, this week. Each step is specific. Each step is immediately actionable. And by the time we reach step 7, the only remaining variable will be whether you actually execute, because the knowledge and the direction will be complete. I want to be direct about one more thing before we start. This video is not going to tell you what the perfect investment is. It is not going to predict market movements or identify the next great opportunity. It is going to give you the clear, simple, evidence-backed framework for making your first investment correctly, in a way that gives that money the highest probability of growing meaningfully over the years and decades ahead. Perfection is not the goal. Starting correctly is the goal. Let us do that. 7 steps. Start to finish. Everything you need to make your first investment this week. Let us go through every single one right now. The 2 mistakes most beginners make before the 7 steps. Let me name the 2 most common beginner investing mistakes, because knowing them in advance is what allows you to avoid them without stumbling into them the way most people do. Beginner mistake 1. Spending so much time researching the perfect investment that no investment is ever made. This mistake is driven by the reasonable belief that more information produces better decisions. And in many domains it does. In investing, for a beginner making their first investment, it mostly produces delay. The research that is necessary to make a sound first investment takes far less time than most beginners assume. The additional research that follows, the continued studying, the comparing, the waiting for confidence, almost never improves the first investment decision meaningfully, but it consistently delays the start of compounding by weeks, months, or years. Beginner mistake 2, starting with complexity. The belief that sophisticated investing requires sophisticated strategies, individual stock selection, sector rotation, alternative assets, complex derivative strategies, is one of the most persistent and most expensive misconceptions in personal finance for beginners. The evidence consistently shows that the simplest possible investment strategy, broad market index funds, consistent monthly contributions, reinvested dividends, long time horizon, outperforms the majority of more complex strategies for most investors over most long-term periods. Starting simple is not a compromise. For most investors, it is the optimal approach. The 7 steps in this video are built around avoiding both of these mistakes. They provide enough information to invest correctly without providing so much that the research loop becomes an excuse for delay. And they recommend the simplest possible approach, because simplicity in long-term investing is a genuine advantage rather than a limitation. Confirm you are ready to invest by step 1. The prequel's the most important first step in investing your first $1,000 is making absolutely certain that this money should be going into investment right now and not somewhere else first. Investing is powerful, but it is not always the highest return use of every available dollar in every financial situation. Before committing your first $1,000 to the market, 2 conditions need to be verified. And if either of them is not met, addressing it first is the financially smarter move. Condition 1, the emergency fund. If you do not have at least 3 months of essential living expenses saved in a liquid, easily accessible account, your first $1,000 is not ready for investment. It needs to go toward building that buffer first. The reason is specific. Investment accounts are exposed to market volatility. If the market declines 30% in the months after your initial investment, which does happen, which is normal, which always eventually recovers, and you simultaneously face an unexpected expense that your emergency fund should have covered, you may be forced to sell your investment at the worst possible moment. Selling at a market low locks in a real loss rather than a temporary paper one. The emergency fund is not separate from your investment strategy. It is the infrastructure that protects your investment strategy from being disrupted by life. Condition 2. No high-interest consumer debt. If you are carrying credit card balances or personal loans at interest rates above 10 to 12%, the mathematically correct use of your next available $1,000 is almost certainly to apply it to that debt first. The guaranteed return of eliminating a 20% interest rate debt exceeds the expected return of most investment strategies. This does not mean you cannot invest at all while carrying some debt. For manageable, lower rate debt, investing alongside repayment makes sense. But for high-interest consumer debt, elimination first is almost always the superior mathematical choice. Think about two people who each have $1,000 to invest. The first has no emergency fund and carries a credit card balance at 22% interest. They invest the $1,000 in an index fund. 3 months later, a car repair arises. Without an emergency fund, they put it on the credit card, adding to the high-interest debt while their investment sits in the market. The second person uses the $1,000 to eliminate the remaining balance on their credit card first. No more 22% interest compounding against them monthly. The following month, they begin building their investment account with the freed cash flow from the eliminated minimum payment, same $1,000. The second person made the higher return decision, not because investing is wrong, but because the specific conditions in the first scenario made debt elimination the better allocation. The mathematical case for eliminating high-interest debt before investing is based on the comparison between guaranteed and expected returns. The guaranteed return from eliminating a 22% interest rate debt is 22% on every dollar applied, with zero risk of that return not materializing. Historical average equity market returns of 7 to 10% per year are expected returns with significant year-to-year volatility and no guarantee. For any debt carrying an interest rate above the expected long-term return of your investment portfolio, elimination first is the mathematically superior choice. If your emergency fund is in place and you have no high-interest debt, your $1,000 is genuinely ready for investment. Both conditions being met means the investment can stay invested through short-term market volatility without being disrupted by life, and there is no competing guaranteed return that beats what the market offers. Montel action this week. Verify both conditions. Check your emergency fund balance. Is it at 3 months of essential expenses minimum? Check every debt you carry. Is any carrying an interest rate above 10%? If both conditions are met, proceed to step 2. If either is not met, allocate your $1,000 to addressing the unmet condition first. Then restart the investment process once both conditions are confirmed. Choose the right account. Type first ... step 2, where your money lives before you decide what to invest in, decide where to invest. Because this decision, which most beginners completely overlook, has a greater impact on your long-term after-tax returns than almost any investment selection decision you will ever make. Different account types offer dramatically different tax treatments, and tax is one of the most significant costs in long-term investing. The difference between investing in a tax-advantaged account and investing in a standard taxable account, compounded over 20 or 30 years, can represent a significant portion of your total investment return. Choosing the right account type before your first investment is not a minor administrative detail. It is one of the highest return financial decisions available to any investor at any wealth level. In the United Kingdom, the primary tax-advantaged investment account for individual investors is the Individual Savings Account, the ISA. Investments held within an ISA grow completely free of income tax and capital gains tax. Dividends received within an ISA are not subject to dividend tax, and withdrawals from an ISA are tax-free. The money comes out with no tax consequence, regardless of how much it has grown. For UK investors, maximizing ISA contributions before investing in taxable accounts is almost always the right decision. In the United States, the primary tax advantage options for most individual investors are the Roth IRA and the 401k through employers. The Roth IRA accepts after-tax contributions and allows all investment growth and qualified withdrawals to be completely tax-free, making it particularly valuable for younger investors who expect their tax rate to be higher in retirement than it is today. The 401k accepts pre-tax contributions, reducing taxable income today and defers tax until withdrawal. For U.S. investors with employer matching available in a 401k, capturing the full employer match is typically the first priority. It is a guaranteed 100% return on the matched portion that no investment can compete with. Other countries have equivalent vehicles, TFSAs in Canada, superannuation in Australia, pension accounts in various European countries. The specific names, contribution limits, and rules vary. The principle is universal. Wherever possible, use the tax advantage vehicle available to you before investing in a taxable account. The tax efficiency compounds just as investment returns compound, and over a long investment horizon, the difference is material. Think about two investors who each invest $1,000 per month for 25 years at 8% average annual return. The first invests entirely through a tax-advantaged account. All growth, dividends, and eventual withdrawals are sheltered from tax. The second invests through a taxable account, paying dividend tax annually and capital gains tax on profitable withdrawals. At the end of 25 years, both have invested the same $300,000. But the after-tax value of the tax-advantaged account is substantially larger, not because the investments performed better, but because the tax shelter allowed the full compound return to operate on the entire growing balance, rather than being partially extracted each year. The investment selection was identical. The account type made the difference. Financial research on the impact of tax advantage versus taxable account investing consistently shows that the account type decision, which account the investment is held in, contributes a significant proportion of long-term after-tax investment returns. For investments held over 20 to 30 years, the tax efficiency of a sheltered account can add the equivalent of 1 to 2 percentage points of annual return to the effective after-tax outcome, which compounded over decades, represents a very substantial absolute dollar difference in final portfolio value action. This week, research the tax-advantaged investment account available in your country. In the UK, open a stocks and shares ISA. In the US, open a Roth IRA if you qualify by income, or confirm your 401k employer match status. In other countries, research the equivalent vehicle. The account opening process typically takes 15 to 30 minutes online through a reputable provider. Do it this week before investing a single dollar. Choose a low-cost, reputable platform. Step 3. Where you open your account. Once you know what type of account to open, you need to choose where to open it. And the criteria for this decision are simpler than most beginners expect. Look for 4 things. Low or zero trading commissions. Many reputable platforms now offer commission-free trading for stocks and ETFs, meaning the only investment costs you pay are the expense ratios of the funds themselves. Access to the investments you intend to hold specifically. Access to low-cost index funds and ETFs from major providers. Regulatory protection. Ensure the platform is regulated by the appropriate financial authority in your country and that your investments are held in your name or protected by a compensation scheme if the platform fails. And a clean, usable interface. Because a platform that is confusing or difficult to navigate creates friction that discourages the consistent action that good investing requires. The major established platforms in most developed countries meet all 4 criteria. In the UK, Vanguard, Hargreaves Lansdown, Interactive Investor, Free Trade, and Trading 212 all offer ISA accounts with access to low-cost index funds. In the U.S., Fidelity, Vanguard, Charles Schwab, and similar established brokerages offer Roth IRA and other account types with commission-free trading and extensive fund selection. In other countries, equivalent regulated platforms exist. Researching the top 2 or 3 options in your country and comparing their fee structures takes an hour and is worth doing. One important note on platform selection. Do not let this step become another source of delay through excessive comparison. The difference in experience between 2 reputable, low-cost, regulated platforms in the same country is almost always negligible compared to the difference between having invested versus not having invested. Choose a reputable option, open the account, and move to step 4. Platform switching, if needed, can happen later. Starting cannot. Think about someone who spends 3 months comparing investment platforms, reading every review, watching every comparison video, trying to identify the definitively best option before feeling ready to open an account. They finally open an account in month 4. Compare this to someone who spends 1 hour reviewing the top 3 regulated platforms in their country, picks the one that looks most straightforward, and opens the account on the same day they make the decision. Both end up with accounts at similarly good platforms. But one starts investing 3 months earlier, and those 3 months of early compound growth are worth more than any marginal platform quality difference could ever compensate for. Matzel action. This week, spend 1 hour, not 3 months, 1 hour, researching the top 2 or 3 regulated low-cost investment platforms in your country. Compare their ISA or Roth IRA options their trading fees, and their fund selection. Choose the one that seems most straightforward. Begin the account opening process today. Most platforms complete the account opening online within 20 to 30 minutes and require only basic identification documents. Decide exactly what to invest in step 4. The investment decision. This is the step that causes the most anxiety in most beginner investors. And I want to tell you directly, it should cause the least. Because for a first investment, the evidence-backed answer is simpler than almost anything else in personal finance. For the vast majority of first-time investors, with a long-time horizon, limited starting capital, and developing investment knowledge, the correct starting investment is a single, broadly diversified, low-cost global equity index fund, or ETF. We have covered index funds in detail in an earlier video in this series. But let me restate the core case directly here, because it is the foundation of this recommendation. A globally diversified index fund owns a small piece of hundreds or thousands of companies across multiple countries and multiple sectors simultaneously. When any individual company struggles, and some always will, it represents only a tiny fraction of the total portfolio. When the global economy collectively grows and businesses collectively generate more profit, which is the long-term historical trend, your fund grows proportionally. You are not betting on any single company, any single sector, or any single country. You are participating in the collective productive capacity of the global economy. And that participation at minimal cost over a long time horizon has historically produced returns that outperform the majority of more active, more complex investment strategies. Specifically, look for a global equity index fund or ETF with an expense ratio below 0.2%. And the best options are significantly below this, often at 0.05 to 0.1%. Search for funds tracking the MSCI World Index or a total global market index, which together cover large and mid-cap companies across developed markets. These funds are available on virtually every major investment platform and are among the most widely held investment products in the world. For a reason, they work. What about bonds? For most investors making their first investment with a long-time horizon, generally 15 years or more, a significant bond allocation is not necessary and reduces expected long-term returns. Bonds become more important as the time horizon shortens and the investor needs to protect accumulated capital from short-term equity volatility. For a beginner investor with decades ahead, the expected return advantage of equities over bonds over long-time horizons is meaningful and should not be given up unnecessarily at the start. What about individual stocks? Not for the first investment. Individual stocks represent concentrated risk. The outcome depends on the performance of a single company rather than the diversified performance of the entire market. Building a properly diversified portfolio of individual stocks requires significant capital, far more than $1,000, and significant analytical time. Index funds provide the diversification from the first dollar invested. Start with index funds. Explore individual stock investing later, with a portion of the portfolio, if you develop the interest and knowledge to do it well. Think about 2 first-time investors each putting $1,000 into the market on the same day. The first spends 3 weeks researching individual stocks and selects 3 companies they feel confident about, allocating their $1,000 across 3 concentrated positions. The second opens a global index fund with their $1,000 on day 1. 1 year later, one of the first investors' 3 companies has struggled significantly, costing them a meaningful portion of their concentrated investment. The index fund investor has participated in the average performance of hundreds of companies, the strong ones offsetting the weak ones across a diversified portfolio. Same $1,000. The diversification of the index fund protected the second investor from the concentration risk that hit the first. For a beginner, broad diversification is not a compromise. It is the appropriate risk management for the amount of capital and knowledge available. The case for low-cost index fund investing over active stock selection or active fund management is one of the most thoroughly documented findings in financial research. Across multiple countries, multiple time periods, and multiple market conditions, the majority of actively managed funds underperform their benchmark index after fees over any period of 10 years or longer. The index fund investor, by capturing the market return at minimal cost, consistently outperforms the majority of more actively managed approaches, not because they are smarter, but because they avoid the costs and errors that active management introduces. Action this week. On the platform you opened in step 3, search for a broadly diversified global equity index fund or ETF with an expense ratio below 0.20%. Look for funds tracking the MSCI World Index or equivalent total global market index. Compare the expense ratios of the top 2 or 3 options available on your platform. Choose the lowest cost option from a reputable fund provider. This is your investment. You now know exactly what to buy. Make your first investment today, Step 5. The execution everything before this step has been preparation. Step 5 is the only step that actually starts the compounding. Everything else was important. This one is essential. Making your first investment is simpler than most people expect. And that simplicity, once experienced, removes the intimidation that has been part of the barrier for many people. On your investment platform, in your tax-advantaged account, you search for the fund you identified in Step 4. You enter the amount you want to invest, your first $1,000, or whatever amount is available. You review the order details, the fund, the amount, the current price, and you confirm the purchase. For index mutual funds priced once per day at end of trading, your order executes at the next available end-of-day price. For exchange-traded funds, which trade throughout the day like stocks, you can see the live price and execute immediately. For a long-term investor, this distinction is irrelevant. Whether you buy at the exact midday price or the end-of-day price matters approximately zero compared to the return you will earn over the following decades. Do not wait for the perfect entry price. The research on market timing, whether investors who try to pick the right moment to buy produce better returns than those who simply buy when they have money available, is unambiguous. Trying to time the entry adds no value over long periods and introduces the risk of the most common timing error, waiting so long for the right moment that significant growth is missed. Buy at today's price. Today's price is whatever it is. In 20 years, it will be the price you wish you had bought at far more of. There is one practical note about the first investment that is worth stating clearly. If your platform offers fractional shares, the ability to invest specific dollar amounts rather than purchasing whole shares, use this feature. It allows your entire $1,000 to be deployed immediately rather than having a portion sitting uninvested, because it is not enough for a complete share at the current price. Full deployment of available capital from day one maximizes the compound growth period. Think about the moment after a first investment is made. The portfolio shows a balance. It is small, perhaps $1,000, fluctuating slightly with market movement. Nothing dramatic has happened. The account looks modest. But something genuinely significant has occurred. The investor has crossed from knowing about investing to being an investor. That identity crossing, that commitment, that first concrete step, changes the relationship with financial planning in ways that are difficult to describe and easy to underestimate. The person who has made their first investment is meaningfully different from the person who knows they should but has not. The knowledge is the same. The identity is different, and identity drives subsequent behavior far more reliably than intention does. Research on financial behavior change consistently identifies the first concrete action, opening the account, making the first contribution, as the critical inflection point between financial intention and financial behavior change. People who have made even a small first investment are dramatically more likely to continue investing regularly, to increase their contributions over time, and to maintain investment discipline during market downturns than those who have not yet made their first investment, even when financial knowledge and stated intentions are equivalent. Starting, however imperfectly, however small, is the behavioral catalyst that everything else follows. Model action this week. Before this video ends, if possible, execute your first investment. Log into the platform account you opened in Step 3. Navigate to the fund you identified in Step 4. Enter your investment amount, review and confirm. The compound growth clock starts the moment you confirm. Not tomorrow, not after the next paycheck now. Set up automatic monthly contribution B6, the system that builds wealth. Your first $1,000 is important. The monthly contributions that follow it, consistent, automatic, growing over time, are what will ultimately determine the size of the wealth you build. Step 6 is where the investment becomes a system rather than a single event. Automatic monthly contributions are the most important structural element of a successful long-term investment strategy, not because they produce a dramatically different mathematical outcome than manual monthly investments of the same amount they do not, but because they remove the recurring decision requirement from the investment process entirely. And that removal is worth an enormous amount. Here is why the recurring decision removal matters so much. Every month that investing requires an active decision, a deliberate transfer from spending account to investment account on a specific day, is a month in which that decision can be delayed, reduced, or skipped. Not because of bad intentions, but because of the dozens of small competing financial pressures, spending opportunities, and motivation fluctuations that characterize every normal month of life. Automatic investments do not compete with these pressures. They execute before the pressures have any opportunity to influence the outcome. The money moves before it can be spent. The automatic investment also implements dollar cost averaging, the practice of investing a fixed amount at regular intervals regardless of market conditions. When markets are lower, the fixed amount buys more shares. When markets are higher, it buys fewer. Over time, this averaging effect produces a purchase cost that is lower than the average market price across the investment period, because the same fixed amount buys more shares during downturns, which have historically always been followed by recoveries. The investor who maintains automatic contributions through market declines captures more shares at lower prices and participates in the full recovery. The investor who pauses contributions during declines or who makes manual decisions that are influenced by market anxiety misses this benefit entirely. How much should the automatic contribution be? As much as your budget genuinely allows after essential expenses and emergency fund maintenance, without being so large that it creates financial strain that leads to the contribution being canceled during a difficult month. The right amount is the largest amount you can genuinely sustain through 12 consecutive months, including the months when finances are tighter than usual. Start there. Increase it when income grows. Never decrease it without a genuine financial emergency requiring the reallocation. Compare the long-term outcome of two investors over 15 years. Both start with the same initial investment and have access to the same funds at the same returns. The first sets up automatic monthly contributions and never changes them except to increase them when income grows. Their investments happen every month during good months and difficult months, during bull markets and bear markets, without deliberation or decision fatigue. The second invests manually, contributing when they remember to and feel motivated to, skipping months that feel tight, pausing during market downturns when anxiety is highest. Over 15 years, the first investor has made 180 consistent monthly investments. The second has made perhaps 90, half as many, having missed months scattered throughout the period. The difference in final portfolio value is not proportional to the missed contributions. It is amplified by the compound growth on those missed contributions that never happened. Studies on investment return gaps, the difference between the returns produced by investment funds and the returns actually experienced by investors in those funds, consistently show that average investors earn significantly less than the funds they invest in produce. The primary driver of this gap is behavioral. Investors add money after strong performance and withdraw after poor performance, the opposite of the buy low, sell high behavior that produces optimal returns. Automatic monthly contributions eliminate the behavioral error by making the investment decisions automatic rather than emotionally influenced. Investors with automatic contributions show significantly smaller return gaps than those making discretionary investment decisions. Action this week. After making your first investment in Step 5, set up an automatic monthly contribution through your platform's recurring investment or standing order feature. Choose your amount. Start with whatever your budget genuinely allows after essential expenses. Choose your date, pay date, or the day after is optimal, so the investment moves before the money has any opportunity to be spent on anything else. Confirm the recurring instruction. The investment system is now running. Your job going forward is to not turn it off. Leave it alone and keep learning Step 7, the discipline of non-action. The final step is the one that determines whether steps 1 through 6 produce the outcome they are capable of producing. And it is the step that goes against almost every instinct most people have about active engagement with something they care about. Leave it alone, not completely, not permanently, but far more thoroughly than most people expect. Once your investment is made and your automatic contributions are running, your role as an investor shifts from executor to guardian. Your job is not to constantly monitor, adjust, react, and optimize. Your job is to ensure the system continues running and to prevent the emotional responses to normal market events from disrupting the compounding that time is quietly doing on your behalf. Here is the specific behavior that destroys long-term investment returns for most individual investors. They watch their portfolio daily or weekly. When markets decline, and they do regularly, sometimes dramatically, the declining balance produces anxiety that feels like a signal to act. The act that feels most relieving in the moment is selling, moving to cash, stopping the losses, getting out until things stabilize. And this action, selling during a market decline, is the single most consistent way to permanently impair long-term investment returns. Because the investor who sells during a decline is no longer invested when the recovery happens. And the recovery, which has followed every significant market decline in the history of documented financial markets, is what produces the long-term return that the patient investor captured, and the anxious one did not. The practical discipline of Step 7 is specific. Check your portfolio monthly at most. Quarterly is better. Review your automatic contributions once a year to ensure they are still appropriate for your financial situation. Rebalance your allocation annually if it has drifted meaningfully from your intended target. Increase your contribution when your income grows. And for all other market events, news cycles, and financial commentary, maintain the conviction that your strategy, consistent, low-cost, diversified, long-term, does not require a response to short-term market movements. The second element of Step 7 is continuing to learn, not to create complexity, but to build the conviction that allows you to stay the course when markets are difficult and doubt is loudest. Every piece of financial knowledge you add to your foundation makes you a more resilient investor, not because it generates better tactical decisions, but because it deepens your understanding of why the strategy works and why temporary market declines are normal features of long-term investing rather than signals that the strategy is failing. Consider two investors who both start with identical portfolios in the same global index fund on the same day. Both experience a significant market decline of 30% in year 3, a real alarming, uncomfortable decline that generates extensive negative financial news coverage and produces genuine anxiety in anyone watching their portfolio. The first investor, checking their portfolio daily, sees the decline as an emergency. They sell, move to cash, and wait for stability before reinvesting. They reinvest 12 months later, after the market has already recovered significantly, missing the sharpest part of the recovery. The second investor, checking their portfolio monthly, sees the decline, feels the same anxiety, and does nothing. Their automatic contributions continue buying additional shares at lower prices throughout the decline. They capture the full recovery. 20 years later, both investors have invested the same total amount. The second investor's portfolio is dramatically larger, not because they chose better investments, but because they left the strategy alone long enough for it to work. Quantitative analysis of individual investor returns versus fund returns. The gap between what funds produce and what investors in those funds actually receive consistently shows that a significant portion of this gap is attributable to the timing of inflows and outflows. Investors who hold their investments through market declines and allow their automatic contributions to continue capture the full fund return. Investors who sell during declines and buy back after recoveries capture a significantly smaller portion. The financial cost of emotional market responses, of not leaving the investment alone, is measurable, substantial, and consistent across every studied time period and every studied market. Action, this week and every week going forward. Commit to checking your portfolio no more than monthly. Write down your investment strategy, global index fund, automatic monthly contribution, long-time horizon, and keep it somewhere visible. The next time the market declines and you feel the urge to do something, read what you wrote, then do nothing. Your automatic contributions are already doing the only thing that needs to be done. The compound growth is already happening. Your job is not to interrupt it. Final message: 7 steps. Everything you need to invest your first $1,000 correctly, this week, not eventually. Step 1, verify the prerequisites. Emergency fund in place, no high-interest consumer debt. Step 2, open the right account type, ISA, Roth IRA, or your country's equivalent tax advantage vehicle. Step 3, choose a reputable low-cost platform. 1 hour of research, a decision, and an account opening. Step 4, identify your investment, a broadly diversified, low-cost global equity index fund with an expense ratio below 0.2%. Step 5, make the first investment. Execute the purchase today, not tomorrow. Step 6, set up automatic monthly contributions. Payday, fixed amount, never requiring a decision again. Step 7, leave it alone and keep learning. Protect the strategy from emotional responses to normal market events. That is the complete framework. Nothing in it requires financial expertise you do not have. Nothing in it requires capital beyond what you are starting with. Nothing in it requires the perfect moment, the perfect market conditions, or the perfect state of financial readiness. It requires only the willingness to take the first step, and then the discipline to let the subsequent steps execute automatically, while time does what it does to invested capital. I want to be completely direct about the most important thing in this entire video. The step that matters most is not the one you do most perfectly. It is the one you do first, starting with any amount, in any imperfect state of knowledge. At any imperfect market moment is worth more than the perfect investment made at some future moment when you feel entirely ready. You will never feel entirely ready. Ready enough is ready enough, and ready enough is right now. The $1,000 sitting in your account or building toward your account is not waiting for a better opportunity. It is waiting for a decision. Make that decision today. Open the account, choose the fund, set up the contribution, and then let time and the most powerful force in wealth building do the rest. If this video removed the barriers that have been keeping you from your first investment, please share it. The most valuable financial gift available to someone who knows they should be investing but has not started is the specific, clear, actionable path to doing it. Subscribe to our Financial Edge for a new video every single week. And leave a comment below. Are you making your first investment after watching this video? I want to know. I read every single reply. See you in the next one.